Good morning, everyone. Thanks for joining us at the Market Chameleon pre-market show. We're having a good webinar this morning. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. Like always, if you're searching for investment advice, please reach out to a licensed professional. This show and all our webinars are for informational purposes only concerning Market Chameleon tools and products. With that, D, good morning, my friend.
Good morning, Will. How are you?
Good.
Good morning, everyone. I'm going to try to share my screen here so we could get started. Let's see how to do this over here. All right, let me know if you can see my screen, Will. And
Yep, I'm adding it to the stage right now. There it is.
Yep. So good morning, everyone. And today we're going to cover how to track an option straddle benchmark. And it's important for two reasons. Mainly, you could use it for risk management or trading strategies, trading opportunities. So we'll cover that and discuss an example. I'm going to use SPY for our example. So to go to it, let's first go to SPY. Type in SPY in this search box. When we do that, we come to the SPY main page. And I'm going to, on the left-hand side, you see a menu under options. Let's go to strategy benchmarks over here. I'm going to close this menu to expand our screen. And now what we see is a page that has different tabs, top. And those tabs represent different option strategies. We're going to look at the straddle today, the option straddle, and discuss this benchmark here. So when we talk about the benchmark, what we want to do is track what is the cost of an option straddle, okay, in this case, SPY. And we do that to be able to compare the cost of the straddle today versus its historical values. We could also compare it to other securities to see how the straddle of one security compares to the cost of an option straddle in a different security. And what is an option straddle? An option straddle is when you buy a call and a put or sell a call and a put on the same strike that's at the money. And when you do that, what your outlook is how much can the stock move from its current point away in either direction, to the upside or to the downside, to cover the cost of that straddle. Okay, so SPY is 575.92. That's where it closed. So if we had an exact straddle that had a strike of $575.92, right, and we wanted to price the call and the put, buying the call, buying the put, or selling the call, selling the put, and we gave it a duration. So we need to, with options, they have an expiration. So we need to define an expiration. In this case, we're looking at 30 days to maturity. So we need a constant 30-day maturity option. And then we want to figure out, well, what is the price of that option spread, that option straddle? Okay. So the issue, why do we have to create a benchmark? The issue is that you're not going to find an exact strike that equals the stock price at every moment in time, right? It's not, they don't have strike prices exactly $575.92, $575.91, $575.90. The exchanges don't list strikes, in those type of increments. Even $576 or $577, you're not going to always find a strike price this way. In addition, if we're looking at the cost of the straddle, well, the cost of the straddle with 7 days to go is going to be different than the cost of the straddle with 8 days to go, or 9 days, or 10 days, because the longer you have, the more premium, right? If you an option straddle that has, let's say, 30 days to expiration, will be worth more than an option with 1 day to expiration. So if we wanted to track the price of a straddle, right, we got to give it a constant maturity and an at the money value, right? So because it doesn't exist, we have to create a benchmark to derive that value. Okay, similar to like the VIX. The VIX is tracking a 30-day constant maturity implied volatility. We have to create that benchmark. So create this weighted average formula looking at observing the options that surround 30-day constant maturity with an at the money strikes, and come up with a formula that tracks that 30-day constant maturity at the money. And then we have to convert it. We could look at the Black-Scholes model, use the implied volatilities, and then take those implied volatilities and convert it to the actual cost. How much would it cost me if I in theory, if I had an option that was the strike price equivalent to the stock price with 30 days to go, we could convert that into a dollar price using the Black-Scholes model. So it could be like $20, $25, whatever it is. The problem is that the stock price moves around too. So we need to kind of normalize that. And to do that, we track the price of that straddle relative to the stock price, the spot price. So if the straddle costs us $10 and the stock price is $100, well, that's 10% move, right? It needs to move up or down 10% to break even on that straddle. Similarly, if the stock is $50 and the straddle price is $5, same thing. It has to move 10% up or down $5 to break even. So that's what we're tracking there. The cost of the straddle relative to the stock price. That's what we're looking at. So here, what this is telling us is based on a 30-day maturity at the money straddle, defines the description. If you're buying a call at the money and buying a put at the money, 30 days constant maturity, the premium will be 3.5%. Okay, so for every, think of it this way, for every $100 worth of SPY, it'll cost $3.50 in option premium. Okay. So now that we know the straddle, how much it basically has to move 3.5% to break even. So that's where the buyer and seller break even. 3.5% move in 30 days. Okay, so from here, 3.5% in either direction. So now we have this benchmark. What can we do? How can we use it? What kind of insights can we get from it? What does this 3.5% mean? Is it a lot? Is it a little? What is it? What can we do with it? Because 3.5% in SPY may be a very big move, but 3.5% in something like Tesla may be not so big, but 3.5% in some stocks, they could do more than that in just one day. Okay, so in one day, there's certain stocks that can move 4 or 5%. So that would be a very cheap straddle. If you have 30 days for to move more than the break-even point. So what is it typically? We could take a look at it and measure it. Well, where does it typically trade, or on average? What was the average value? If we looked at history and we looked at daily closing values of the option straddle and SPY, took the average. What's the average? Okay, and are we above it or below it, and by how much? So if we took the average for the last 52 weeks over here, we see that it's 2.5%. In other words, that the option prices, on average, implied a 2.5% move in either direction. Now we're at 3.5%. Obviously, that's now adding an extra 1% point move. So now we kind of see that we're above the average, right? We're already, more on the higher end than the lower end of expectations, because the straddle is forward-looking. This is the market signaling to us that now they're anticipating a larger move than they typically anticipate, right? 3.5% versus 2.5%. Here, the change is letting us know what it changed on a day. So similarly to a stock price change, we know that SPY is up 0.6% on Friday. We're not. This is using Friday's closing prices. So the stock was up 0.6%, and the benchmark was down 0.3%. Okay, so we know what it did on the day, and now we have a comparison to its 52-week average. And a couple things here. We know how much it is to now hedge the movement, right? If we're concerned about the movement in either direction, or we want to sell premium in either direction, we know what the cost of that is. Okay, and that the risk premium has gone up based on historical averages. Here we see the graph, just like you graph a stock price, daily closing stock price, we see the daily cost of that straddle, right? So now we have a 1-year look back, how the price of that straddle fluctuated. We could see, how low it got, how high it got, if there's any trends. And this dotted line is the 52-week average. So we could see how far we are from the 52-week average currently and how far it's gotten historically. So we see all the way up here, if I manage to hover at this peak place right here, I think it was like around 5%. So we're not at the very high of the last year, but we're definitely above the average, and it looks like on the higher end than the lower end. And by putting that average in, we could also just visually see how far away the straddle fluctuates around the average. Okay, so that's now the 30-day constant maturity. Well, there are other ways to make a relative comparison. Now that we have this benchmark, we could start comparing it to other benchmarks for relative values. Right now, we got a relative value based on its own historical, right? Based on its average, based on its high and low range for the year. What about comparing it to a different maturity. So we could slide down a little bit. And now we have a 60-day maturity option. Same idea here, except we're going to 60 days instead of 30 days. And how does that look? Is it also on the high end? Is it above the average? Did it move up or down on the previous day? So here we could see that on the 60-day maturity, we are at 4.8%. So just comparing it between the 30-day and 60-day, we see that we're adding another 1.3% cost to that straddle. Right. So if we for $100 worth of stock in SPY, it'll cost $3.50 for that straddle. But if we go out another 30 days, it'll cost us $4.80. Okay, so we're adding another 1.3% to go out an additional 30 days. So here we see that how far are we away from that, from its 52-week average, the 60-day? Well, the 60-day is 1.2% above its 52-week average. So if we looked at history, we're above it, right? Typically, you're looking at 3.7. Now we're at 4.8. That's 1.1% more than this dotted line, the average. You could also take a look at the difference here. So we know that the difference here, we're paying, and think of time spread strategies. Or what are time spread strategies? Your time spread is you're choosing either, when you're looking at options, which maturity, which spreads offer the most value, or you could trade one expiration versus a different expiration. That's what a time spread is, right? Time spread is where you're looking at same strike, different expirations. When you look at a call spread, it's same expiration, different strikes. Time spread, same strike, different expirations. So now we see that the spread between the 30-day and 60-day is 1.3%. Well, how does that compare to the 52-week average? Well, the 52-week average for a 30-day constant maturity is 2.5 versus a 3.7% in the 60 days. So now we got a 1.2% spread historically versus a 1.3% spread currently. So similar, not they don't look that they diverge by that much. They're both higher, and than its 52-week average, but the difference between the two, 30 and 60 days, just looks like that it's still in line with those averages. Similarly, we could go to the 90-day, right? So, sorry, this is from the 60-day. Here's the 90-day. And then we got the 120-day, right? So now we got so we got these 1, 2, 3, 4 different maturities to be able to compare how that premium is increasing as we go out further in time, how that premium in each of those benchmarks compares relative to its historical averages, and then we could compare the differences, the relative values between the premiums. Right? So there are we just covered a lot of relative values. Right? We looked at the relative value versus itself, its averages, and its highs and lows for the past year, and then the relative value of the one benchmark versus another benchmark. Okay, so Here we see on the 90-day, the difference between 90 and 60 days is 1%. Okay, so we've got a 1% difference between 90 and 60, which is in line with the averages. We had 4.7% versus 3.7. So while the volatilities, the implied volatilities, and the relative cost of those straddles has gone up, the curve itself kind of shifted. It appears that it kind of just shifted in proportion, like though so the skew between those expirations didn't widen out. They're kind of in line with those historicals. Because if the skew between the 60 and 90 day shifted by a lot, we would see a bigger difference. Or maybe we would see the difference between this benchmark and this benchmark. Instead of 1%, it would be 1.5% or maybe 2%. Then we could see that, wait a minute, the skew, the relative skew based on history has, expanded or flattened, but so far we're seeing that skew looks like it's maintained relative to how we've observed it in history. All right. And think of time spreads. So let's take a look at the 120. What about if we go a little bit further out? Let's say we go out to 120 days out. So here we see that the current cost of that straddle is 6.7%. Okay. Relative to its averages of 5.6%, it's also higher than the averages by 1.1%. Okay. And just going down the line, we see how much it increases, right? We have this 30-day, but from the 30-day to the 60-day to the 90-day to the 120-day. And a couple more insights we could get is if we looked at the 60-day straddle, if we took the 60-day straddle and wanted to get a sense of if the stock, let's say, is at the same spot, like let's say we took a 60-day straddle and we waited 30 days. That means there's 30 days left to go. The stock moved around and came to the same spot. How much value do we think we would lose in that strat? How much would it cost us to hold it from 60 days for 30 days? And let's say we stopped there, right? We got out of it in 30 days. Well, this gives us a sense of the risk that on average, if a 60-day straddle is 3.7% and a 30-day straddle, because eventually the 60 days will become 30 days, right? Tomorrow will be 59 days, 58, 57. So how much are we looking at to potentially lose on that straddle if we get back right to the same spot? What if it doesn't move, or moves around, comes back to the same spot? So from 60 days, in 30 days, we're looking at, on average, a decrease of 1.2%. Okay. So if we bought a straddle for $3.70, let's say, for $100 worth of stock, if we bought it for $3.70, historically, and we looked at it in 30 days, what would it be priced 30 days? In 30 days from now, with 30 days to go, it'd be priced at $2.50. So we're looking at, a potential loss of 1.2%, $1.20. Okay, we could do the same thing from the 90 days to the 60 days, or from the 120 days, we could do it to the 60 days. So I'm going to stop there, and we could similarly take these benchmarks and compare them to other products that are similar, like QQQ, or you want to compare it to a single stock. But the idea behind the benchmarking is that now when we have the benchmarks, we could assess potential risks and trading strategies based on if our outlooks, if we think that there's going to be a lot of movement or not a lot of movement, or time spreads. So I'm going to end it right there.
Yeah, that was awesome. Great job, everyone. Thanks for joining us on this wonderful day and webinar series. We do have an interactive broker webinar tomorrow, D, I think, analyzing open interest, correct?
Yep.
So I'll put that link into the chat, because you have to register.
You have to register with Interactive Brokers, because they're hosting it. It's going to be on their platform. It will be a discussion on open interest. We're going to first just talk about open interest, how it's calculated, and how we could use some tools to analyze the open interest.
Yeah, great job, D. As always, thanks for all the chameleons and the new users joining. Remember to like us and follow us on YouTube, Facebook, LinkedIn, everywhere we are. Great job as always, D. And everyone have a safe trading day. Bye.
Thanks, everyone. Bye.